Good morning, ladies and gentlemen, and thank you for joining the second day of the BCI Offshore Investment Managers webinar. On screen now is the agenda for today, and we have another lineup of some of the top global managers across the world to share their views. As always, as you know, the presentations and recordings of these sessions will be shared on the Boutique Managers website, and we will also send you a link to those recordings. The session today will be fast-paced, but there will be time for a couple of questions after each presenter, as per usual. And you're more than welcome to hit that Q&A bubble and post questions that you may have, and all those important questions that your clients are asking you of late. Last week, we had interesting viewpoints on companies and sectors that can benefit from AI, but we also had some health warnings around AI, like circle of funding issues and constraints around the energy grid in the US. Quality managers made the argument that we may see a pivot back to quality, while value and emerging market managers see renewed opportunities with a weaker dollar and growth valuations at a premium. How much can tax reform in the US offset some of the concerns around the labor market? Yes, they do have strong GDP growth, but consumers are starting to pull back on spending in fears of losing jobs. Today, we will continue discussions on quality and value opportunities in and outside the US, and we will also look at things like credit and where that fits into a well-diversified portfolio. With that, we're going to jump right into it, and it's my absolute pleasure to welcome our first presenter of the morning, no stranger to the audience, Paul Crawford from Fairtree. Good morning, Paul. How are you doing?
Good morning, Eugene. I'm very well. How are you?
All right, thank you, Paul. Always great to have you with us. And for the audience that didn't know, Paul is back in Cape Town from London. Very happy about that. And Paul, we're also happy to have you back in SA. Thank you so much.
Thank you. Okay, so let me just share this 12 right in. Okay, yeah. We have 15 minutes, so I'd better get started. Yes, hello from a lovely Cape Town. It's a little bit blustery outside. It's going to be a rather charming 28 degrees today, which is quite different to what I've been used to over the last 8 years in London. But anyway, so today I'm obviously going to speak about the Fairtree Global Income Plus Fund and its feeder fund equivalent, which is the one you can invest in here in South Africa. And I've entitled this presentation, Give Some Credit to Credit Funds. So here we go. A little bit of a disclaimer, which we'll just. So I'm actually going to speak about 5 specific things today. I'm going to just give you a little brief overview of what it is. We've done this before, but I think it's quite important. And we're going to look at the long-run performance of the fund. We're going to have a quick look at the fund itself. That's going to be very quick. And then we're going to have a look at essentially the question that we should all sort of be asking, and that's like, is credit itself an expensive asset class to be getting involved in at this juncture? Or should we be pivoting to things like quality or value or growth in equity markets? Well, let's just have a look at the relative valuations thereof, which I think is a sort of decent approach to see if credit is expensive or not. So here we go. Right, so the feeder fund itself, it was launched after we launched our Global UCITS Fund way back in January 2019. Predominantly, it was there for South African investors to get access to a well-diversified euro-denominated UCITS fund. And they would be able to access it in an FX unhedged basis. So they would take direct exposure to euros translated in rand. So they would see the FX risk coming through in the sort of quarterly, monthly, and annual returns. Paradoxically, investors into the Fairtree BCI Income Plus Fund, they also get an indirect exposure because Fairtree BCI Income Plus actually invests straight into that feeder fund, but it does hedge the FX risk. So that's a main sort of difference. Income Plus hedges risk, the global feeder does not. So you're just sort of you're trading that sort of FX risk component. That's what you're doing. The fund itself was launched on 12th of April 2018. This is the most important point, and I continue to say it. It's a roll-up fund. So it's capital only. So it's got pretty decent tax treatment. So any gains is seen as capital. It doesn't pay quarterly distributions. It's a pure capital. It's a capital asset. Its benchmark is the iTraxx Crossover Total Return Index in rands. So it's translated. For those I've banged this drum for long enough now, it's 70. The iTraxx Crossover itself is 75 equally weighted sub-investment grade European credit names. Now it's sub-investment grade credits, and then everybody jumps up and down and says, oh, that's sub-investment grade, very risky. Well, remember at this time, South Africa itself is a sub-investment grade credit. So if you're comfortable investing in South Africa, which we all are, me especially, you should be quite comfortable with sub-investment grade European credit. The index itself, it's a great index. Been running since 2006. It ticks all the boxes for those that like to do that. It's well understood, it's well traded, it's represented, fungible, replicable, all those good things that you do in your CFA. So there we go. Right, so the feeder funds invest directly into the global fund. That was launched in January 2019. It's a spread capture fund, invests predominantly in euro, but it's got some pound and US dollar assets. Pound and US dollar, FX risk is hedged back to euros. So it's a euro denominated. What does it invest in? Everything. Corporate bonds, AT1, perpetual prefs, index-linked notes, tranches, just about everything. It's legislated and regulated by the UCITS, which has got a 5-10-40 rule for those that want to find out more about that. You can talk to me afterwards. But essentially, it's a lot more stringent than what you're used to in South Africa, the old BN90, which sets out concentration limits. Last point, like our unit trusts, we've never side-pocketed. We've never had to run up some other strange funds on the side. We don't mark our own assets. That seems to be a new thing, isn't it? You mark your own homework. Yeah, you mark where you think these things should be. But yeah, we don't do that. So yeah, so what you're seeing is clean and it's real. Yeah. Anyway, so let's have a quick look at long-run performance. This is what I showed you last year. It's almost literally to the day. So this was a year ago. I showed you this graph, these traces, and I showed you the feeder fund, the STEFI, the Fairtree Income Plus Fund, they'll all be in the top 40. So these are basically indexed to the start date of the feeder fund back on 12 April 2019, indexed to 100. And here's what you would have got on an after fees basis. If you read the disclaimers, it tells you all about the TERs and all that jazz. I'm not going to take too much time. But there we go. So obviously the 2 unit trusts are after fees. There's what you would have got. I just want to show you those numbers all look very similar. In fact, the traces all seem to converge at the end, don't they? Well, a year later, and this is what's happened. Essentially, we've seen a massive spurt in performance from all global risk assets. I mean, the top 40 was up. The top 40, that's local equities, obviously, inclusive of reinvested dividends. The top 40 total return index did 47.66% last year. Goodness gracious, a phenomenal return. And that's where you see that blue trace. It just spikes up. There's a little spike down. That's when everybody thought the world was about to collapse. After the president of the United States announced a global war on tariffs, everybody thought, oh my goodness, this is the end of the world, blah, 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 blah. Well, after that, just risk markets just took off. I mean, it was just a phenomenal story. And we actually freaking benefited massively from that. 47.66% on equities. The oil bond index had its best run ever, 24.24% over the year. The green trace had its best year in history. It also had its longest winning streak in history. We're now into 13 months of positive returns. That's the longest winning streak it's ever had. So we've had a phenomenal story going on with the global tailwinds, blah, 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 all these good things. So anyway, it's been an absolutely phenomenal story. Yeah. So there we go. So a bit of a disconnect there. So suddenly the Income Plus and the feeder fund look to be languishing a bit with regard to the other asset classes. That's a fact. That's basically due to what happened last year. Look across all the returns. I'm sure Anthony is speaking after me. He's going to talk about that as well. Equity markets had a fantastic year last year globally. Anyway, so how have we done against the benchmark? That's probably the most important thing. So again, what I've got here is I've got the feeder fund relative to its benchmark, which is the iTraxx crossover in rands. These are the total returns compounded annually per annum numbers. There's where it's performed, how it's performed. That's the, it's outperformed marginally. It's not blow your hair back sort of stuff, but I mean, it's outperformed after fees. So we're pretty happy with that. So you can see it's tracking it rather nicely. We're quite happy with these returns. This is from 12 April until 11 April, sorry, till 27th of January 2025. Yeah. So let's have a very, very fast look at the fund. This is the only slide I've got on this. I know that's a busy slide. The bottom line, this is all you need to sort of know. It's well diversified. We've got 44 instruments in there with 361 different obligos. So we've got 361 different underlying names that make up that portfolio. Now, if one considers that the index itself has only got 75 names, you can see that it's much more diversified than the very index that we're following. So that should give you a little bit more comfort. Yeah, okay, so that's all I've got to say about it. Is credit expensive? That's the next thing. So here we go. What I've got here is I've got the iTraxx crossover spread index, which is our sort of benchmark spread index. This is in basis points. And currently, if you look at the graph, the spread is currently sitting at, let's call it 244 points, which is optically looks pretty damn expensive, doesn't it? If you consider that the average since inception is sitting just shy of 400 points, it does look a bit expensive, doesn't it? I mean, you look at this and it sends a shiver down your spine, doesn't it? Yeah. Terrible. Well, anyway, once we actually have a look at it relative to other asset classes, what I've got here is I've got the earnings yield of the SX5E. That's a European large cap index, sort of the Dow Jones equivalent in Europe. So if I look at the total yield of the iTraxx crossover and compare it to the earnings yield of the SX5E, you'll see that both of them have sort of rallied of late. Both of them have. Now, the more interesting thing is if we start looking at the differences in these yields, we can see essentially that SX5 equity earnings yields has compressed the credit yield quite significantly. So arguably, relatively speaking, equities have caught up quite a bit with credit, and credit right now is looking a tad inexpensive relative to equities from a European standpoint. So yes, credit is expensive by historic terms. Yes, I'll give you that. But relative to its equity counterparts, I would say that it's relatively cheap. And that's the most important thing I'd like you to take away with you today. If we have a look at total returns, you can see exactly what I've been talking about, the SX5E in blue. You can see it's spurt over the last sort of year compared to the total return. This is indexed to 100 way back in March 2007. The iTraxx crossover is sitting, you would have got about 176% return over that period in euros. Equities over that period about 180, but you can see it's back end loaded. And I'm going to give a little talk about that just now, which is probably the most important thing I'm going to say today. So now we're into conclusions. And to conclude, I'm going to start with this. Now, this is, interestingly, I've got a table of two funds, two hypothetical funds. And then we're having a look at their performance over a 10-year period. Looking backwards, Fund A has done 10% per annum consistently over the 10 years. Fund B, it did 100, according to the CAGR, it did 159%. And last year, it's done 61% per year for the last 2 years, 37% per annum for the last 3 years. And so it continues. Down to over the last 10 years, it's also done 10%. Now, the question is, which one would you prefer? Now, looking at the numbers, one would say that Fund B dominates Fund A, wouldn't you? I mean, look at that. Goodness gracious. Over 5 years, Fund B has done 21%. Fund per annum. Fund A has only done 10%. I'm investing for 5 years. Therefore, I should probably take Fund B, wouldn't I? Yeah, probably. If I'm investing for 10 years, I'm actually indifferent. So it's like a no-brainer, isn't it? I'll take the one that's done 21% over 5 years. And even over 10 years, it's done the same. So surely Fund B dominates Fund A. Well, this is the problem when we just look at numbers. When we look at things graphically, we see something quite different. Fund B actually did nothing. By the way, these are the numbers which generated the previous table. Did nothing for the first 9 years of its life, and then did all of its return in the 10th year. Whereas Fund A consistently gave you 10% return over the entire 10 years. Now, which one would you prefer there? Well, I would argue that Fund A gives you consistency. Fund B, goodness gracious, heaven help you if you got out at the wrong time, or had to disinvest, or took a lot of, I don't know, maybe you needed a whole lot of income one year. You would have been in a bit of trouble, yes. So Fund A shows you that it's outperformed, even though it's giving you more consistent performance. And the numbers lied to you. So just always be very careful in analyzing numbers. A picture tells you much more than what the table does in performance. So always try to graphically look at what people are telling you. Don't just take a table of returns, of compounding per annum returns, and then try to make some sort of judgment on which one is better. That's quite dangerous. So to conclude, 2025 was an absolute cracker of a year for global risk markets. Make no mistake about it. It was a phenomenal year, in spite of things going on geopolitically, in spite of what everybody thought was going to happen after the global war on tariffs, in spite of having a Labour government in the UK. I mean, the FTSE last year did 25.74%, in spite of the Labour government. It's absolutely crazy stuff. Equities locally did 47.66%, the top 40 total return index. Amazing, or albeit its best year ever. So local markets had a fantastic time. And you've seen that how things have changed, how the CAGR numbers have changed. Things suddenly look like credit's terrible, and these more risky assets are so much better. Look at the historic numbers. Well, you can't really do that. You've got to look at the performance traces. Our fund itself, we're quite happy with it. It has outperformed its benchmark since inception on an after fees basis, but only marginally. But it has outperformed. So we're quite comfortable with that. As far as the outlook for credit, yeah, arguably historically speaking, it does look a little stretched. I'll give you that. But at the end of the day, looking at it relative to equities, equities look as if they're looking a little bit more expensive than credit at the moment. Yeah, the earnings yields had converged on credit yields, which, hasn't really happened for some time. So my sort of bottom line is, if you're worried about credit, if everybody's worried about credit, you should be very afraid of the risky equity markets and even the more riskier currencies like the rand. Again, you're probably going to hear about it a lot more about this weak dollar story and, global tailwinds for the rand. I agree with that. In fact, I think this sort of weak dollar period could go on for quite some time, sort of 4 or 5 years. We've only really just started it over the last year. So it could go for quite some time. And then we could see, we've got some pretty good tailwinds in South Africa at the moment. I'm actually very bullish, paradoxically. So I just want to say that. Right. My very last point, be very, very careful when you look at historic numbers, tables of 1 to 10 year performance compounded. Be very careful because it hides more detail. Always try to look at traces of returns and have a look there. That's what I would suggest, and that's what I'm going to leave you with today. Thanks so much for listening to me over the last 15 or so minutes.
Well, thank you very much for that. I think, with webinars, you can never see the audience, but I'm sure there was a couple of our audience members that cracked a smile. It always happens when you present and the way you phrase things. Just an observation, and I think it's very often missed, is that your Global Income Plus fund is a roll-up fund. You made that point,
Yes.
but definitely, from if you look at discretionary assets, it does put a client in a preferable net after tax position.
Yes.
If you were to compare it to normal fixed income funds where they have distributions and the tax liability can get a bit heavy. It's always a good place for these kind of things in client portfolios. I know there's always somebody that's looking for a little bit of dry powder in maybe a global portfolio. They can buy into the euro-denominated version, or if you're looking for feeder, the feeder fund is there. And if you're not sure where it finds place, it also pulls into the Fairtree BCI Income Plus in the global component, so it forms part of that fund as well. Just one question, Paul, if you're looking at current yields, yes, you did show the graph that credit spreads did pull in a little bit, but that consistency is always a big factor if you consider funds in client portfolios. But what can investors expect for 2026? There's that crystal ball question for you.
Okay, so let's rather start with the global, and then we'll sort of make an assumption about what Rand Euro is going to do over the next year. So I reckon, to be frank, I think we're looking at sort of not the sort of 7-8% that we've been witnessing over the last couple of years in iTraxx crossover itself, but we're probably looking at the sort of the 4 to 5% context in euros. I mean, that's sort of what we're going to be looking at. I reckon we'll generate about 3% on spread this year, and then Euribor sitting at, let's call it 2%. We're looking at 4.5 to 5% in euros in hard currency. As far as Rand Euro is concerned, remember, Rand Euro is not going to appreciate as much as Rand Dollar in this weak dollar environment. So maybe take a couple of percent off for Rand Euro appreciation, but we're not going to do against the euro what we're going to do against the dollar. And you've noticed that of late, that you've seen sort of massive gains against the dollar, but not that much against the euro. So maybe take a percent or two off. So we're probably looking at, I know this doesn't sound very exciting at all, but we're probably looking at somewhere between sort of 3 and 4% for the fund this year. It is going to be a pedestrian year this year. I've got that sort to say, but it should be a low vol year. So that's an after-tax number as well. So that's sort of what we're looking at. Again, if we see further compression, we could add another sort of 3 or 4% on top of it, thanks to the market maybe rallying another 50 or so points, which I think could quite easily happen on the iTraxx crossover. But it's not going to give us what we've been getting we've become accustomed to. Remember that we hedge all currency risk in the Income Plus fund. So that 5% I'm talking about is going to translate into sort of 8 to 9%, because it's basically JIBAR plus 3% is what we're getting after we've hedged the currency. So we're getting back to sort of, probably about 9.5% from our offshore assets. So that's sort of what we're going to get from our local assets as well. So probably to be frank, a little more bullish on local than offshore at the moment. But remember, that's more of a currency play than a credit play. I am more bullish on European credit than domestic credit, but I'm certainly bullish on the Rand. So you've got these sort of opposing forces at the moment. So that's the way I'd sort of explain where we think the returns are going to come this year.
Yeah, might be pedestrian, as you mentioned, but it's still well above inflation, well above cash. It comes with very low volatility. You manage the credit risk extremely well in the portfolio, as you've always done. And like I said, if you're looking for some dry powder in portfolios, it's a good consideration with the added tax advantage. Paul, thank you so much for joining us this morning. It's been very insightful indeed. and always great to have you on these sessions. Thank you so much.
Thank you so much, Eugene. Have a good one. Cheers.
Right, fantastic. We are moving on, and it's my great pleasure to welcome Anthony Ginsberg, Managing Director at Gins Global. Anthony, thank you so much for joining us this morning. Our time, very late evening, your side again, all the way from Los Angeles, California. So we can jump right into it, and then you can jump into bed.
Thank you, Eugene. Always great to be with you and all your colleagues. Just to say, you put at the heartstrings of an old South African when you start off with Johnny Clegg blasting through at the beginning of your webinar. So thanks for that. Even though we have a Super Bowl coming up next week, I still get more excited, I think, about the Rugby World Cup and what Russie is doing with it over there. So I'm going to talk about the global indexing revolution that has occurred here in the US and has filtered through to other countries. Basically, more than half the money today in mutual funds and in investing is in index funds or ETFs, which essentially are now taking over from the mutual fund concept in America, partly for low-cost reasons, but there are also some tax benefits as well, because index funds by their nature don't churn the portfolio that much. We'll just skip along to the next slide, and I'll happily answer any questions. I just want to give you a little bit of background. Gins Global is actually celebrating its 25th anniversary. I came over here over 30 plus years ago, worked on Wall Street at Solomon Brothers and then at Barclays. And we saw the indexing revolution back in those days with the likes of State Street, who we still work with. It's one of our cornerstone partners, and Vanguard, of course, as well. And it's become a lot more mainstream. There's a great book called Trillions that is written by an FT writer from the Financial Times, all about this massive revolution. We see it not just in ETFs. So we've got a bunch of ETFs listed on the London and German and other stock exchanges in Switzerland as well. We also offer a broad range of index funds, and we're very pleased with the BCI Gins Global Equity one, which is a cornerstone for global equity. But of course, indexing is also infiltrated across life insurance. We've designed products, and we still do, with the likes of Transamerica, AIG, Zurich, and also on the banking side, you'll find their annuities and bank products with Citibank and JP Morgan, Royal Bank of Canada as well. So without further ado, I just want to thank everybody on the call for your support, because if you look at the next slide, we've got almost 2 billion Rand right now in our global equity index fund with BCI. Thank you to Eugene, Robert, and Olga and the team, and Tanya. It's a very low cost TER, around 33 basis points. It covers in one fell swoop over 1,320 shares from 23 developed markets. We'll go through it in a little bit of a brief background. Obviously, the US dominates it. And although President Trump is certainly not everybody's cup of tea, I'm here to tell you, here in California, we're miles away from any recession. I've been traveling extensively. The airports are busier than you can ever imagine, other than when we had to cancel 15,000 flights over the weekend with the gemors and the terrible weather. But besides the snot and trana of last week, the travel, the restaurants, everywhere is as busy as you'll ever see it. Unemployment is at about a 4% level, so we can talk about the labor market as well. But this is a very low-cost core approach to basically buying global equities. The PE ratio is just over 20 times. And we'll move on to the next slide. We've worked with State Street for 25 years, because they've got essentially the second largest index fund provider in the world. I also wanted to just thank BCI, because we're launching now a feeder fund into our very popular, almost 8-year-old tech megatrend ETF is listed on the London Stock Exchange and also in Germany and across Europe. And this has 140 stocks. My main point is indexing is a very broad-based approach. And this is a broader way of investing in AI and other tech areas, such as digital entertainment, social media, cybersecurity, cloud, quantum computing, in a safer approach. It's not just buying the Mag 7, which a lot of tech funds are very top heavy in that. What we've done is we equally weighted, and it's rebalanced every 6 months. And this has actually doubled people's money in the last 3 years. So we cover blockchain, cloud computing, all the key cornerstones, but there are 140 equally weighted stocks. It's a much more diversified, lower risk approach. I mean, the NASDAQ currently, half of it is represented by just the Mag 7, which actually have underperformed of late. We'll just move on to the next few slides and just show you quickly on the mega trends. If you compare the S&P and the MSCI in green and in purple there, the mega trend index itself over 3 years has basically doubled folks' money. So $100 would have been worth now $200 over the last 3 years. So it's a satellite approach for people, obviously, technology, but this is a broad way of doing it in a safe approach. And hopefully it's going to be added to a number of the platforms just in the coming days in South Africa. So finally, there's a low-cost feeder approach into this ETF listed on the London Stock Exchange. And we'll just move on to the next few slides. Well, this just summarizes how we've done 140 holdings. We basically have 15 leaders from each of these categories. So whether it's gene editing or cloud or AI or robotics or future cars, quantum computing, we basically have picked the leaders in each of these areas. And it's a global approach. It's not just the US. Unlike the NASDAQ or the Mag 7, which are just completely US-centric, even though I'm living here in California, I'm here to tell you that we can't avoid Tencent and Baidu and Alibaba in China, and we can't avoid some of the top robotics companies in Japan and South Korea. So that's why we have a global benchmark. So there are ways to invest in tech in a diversified approach, and that's what we've done. Interestingly, this is not your father or your early career bubble, in our opinion, because in 99, 2000, the PE ratios were through the roof. They were at 60 times on the tech stocks. Today, this particular fund has got a PE ratio of just around 20 times. And we're talking about subscription revenues, the likes of Netflix and cloud computing. In the old days with the internet bubble, those companies did not have subscription models. They didn't have strong cash flows. Also, they didn't have the benefit of tailwinds. In America, we have obviously the Fed lowering rates here. Again, not just last year, but we're expecting 2 further rate cuts. And there is additional tech convergence here. And also the lack of red tape, the fact that President Trump, for all these negativity ratings, has actually created fiscal stimulus. There are tax breaks. There are massive infrastructure tax breaks to build data centers here. There's a reason why the US economy is powering ahead at over 4% GDP currently. We'll go ahead. If you were in the MSCI World, which is the main benchmark we're using for the global equity index, just to come back to that fund, it's been available through BCI now for just over 3 years. The $100 there, I should say, in euros, 100 euros has grown to 520 euros in the top blue line there. Emerging markets have been reasonably flat until last year. And the all-country world, which includes emerging markets, would have pulled you down. That's the MSCI ACWI. So actually, MSCI World, the 23 developed countries, has performed best. And here in the States, we see people separating MSCI World from emerging markets because they recognize that there are different building blocks. So we just provided the developed world building block, and essentially we're showing people how it's performed. If you just look at the USA specifically with regard to the rest of the market in the next slide, the USA has significantly outperformed in the next slide over the last 20 years. So ignoring the US at your peril is what we're really saying. It's I know, as we say, there's a lot of volatility in what President Trump's remarks are on a daily basis, whether it's Greenland or whether it's tariffs in Korea overnight. But truth be told, there's less red tape, there's deregulation going on here, there are tax incentives. This big, beautiful bill you've heard of from Congress is throwing out significant tax rebates to the individual consumers in America as well. So we're expecting close to 3.5% GDP growth, maybe even 4% GDP growth this year. So I think we ignore America at our peril. And we'll just go on here just to show you over 10 years, you would have tripled your money in the MSCI World. $100 would have been worth almost $300. That's a 12.2% annualized return in dollars. And over 5 years, you would have essentially doubled your money from $100 to 185. And certainly if you go through the years, last 5 years, they've had significant gains. 19, 20% returns. It was only during COVID that we saw a negative number there. But the US does comprise the largest slice. So let's go to that pie chart if we can. Following the US at 73%, you see Japan, UK, Canada, France. But at the end of the day, America's got the largest market capitalization. So it shouldn't surprise folks. I wanted to say one thing about the weaker dollar. It's actually very good news for the MSCI World because it's a tailwind for the likes of the Microsofts and many of the Fortune 500 companies here that are exporters. They actually bring their offshore earnings, their euro earnings, their yen earnings back into the US, and it inflates their earnings. So we're expecting 15% earnings gains, earnings per share gains this year on the market. So that's why the S&P overnight touched a new record high of almost 7,000. So I know it's often a rand story for us in South Africa, and the local is lekker, but S&P just hit a new high, and I think at these levels, in the 15 rand to dollar levels, bleeding more money in over time seems to make a lot of sense. So we'll go on to a few more slides to show you about the revolution that we were talking about earlier on. In green, you can see over the last 15 to 20 years, the impact of indexation, which we call passive investing in America. All the large pension funds, CalPERS, many of the largest endowment university institutions here, the financial groups, they all have moved into ETFs or into indexation in a huge way. And today, as I say, more than 50% of flows are using index funds primarily for low cost, but also that they've outperformed. So we'll go through a couple of slides now. The next slide or two will show you part of the revolution where trillions of dollars have flown out of active traditional mutual funds or unit trusts in green over the last decade or two and into the blue passive line. So we've had over 3 trillion essentially now flowing into index funds and ETFs. So it has been a wholesale financial revolution, partly because anywhere between 80 to 90% of most equity fund managers underperform the S&P 500 year over 5 and 10 years. So we'll get to that slide in a moment. If we could just get there, I'll show you. This is, again, the outflows from traditional equity fund managers and how, unfortunately, they've suffered over the last 10 to 15 years as the transparency of returns is shown. This just summarizes the myth of the stock pickers market. Certainly in the US, we have massive amounts of closure of funds. So over 70% of funds are closed here over a period of every 10 years. And as I mentioned to you, overwhelming majority of fund managers do fail to beat both the S&P 500, but also global indexes such as the MSCI. And more, there's a mixture. People use a core and explore. They'll use active managers more for the satellite piece, but the core part or the base of the pyramid really tends to increasingly be indexation at low cost. The next slide will really just show you some performance over 10 years in the yellow. 86% of US fund managers did not beat the S&P over the past 10 years, and 87% over the past 5 years also did not beat the S&P. And when you go down to mid caps and small caps, the numbers may look slightly different. But again, overall, you're talking about a needle in a haystack to try and find those fund managers that will consistently over 5 or 10 years outperform. And that's the reason indexation has really taken over here. Even over 1 year, it's a minority of US fund managers beating the indices. Last year, about 30% of large cap fund managers did beat the S&P, but on a sustained basis, it goes down to about 10%. And at the end of the day, people call it an expensive gamble to overweight with active managers. So here's more of a blended approach with passive and active being seen as the best approach. I just have a few more slides, and then we can take 1 or 2 questions. This approach just shows you on the global side how difficult it has been for even American fund managers who dominate the global stock market, frankly. Over 10 years and over 5 years, the 10-year numbers are in yellow. I believe that these slides, Eugene, will be provided to everybody. But almost 92% of American fund managers underperformed. Essentially, it's called the S&P World, but it's identical or very close to the MSCI World benchmark. It's very, very similar. So I just wanted to show you that as of last year. And just on the US side, it's not that we're guns blazing on how amazing America is. It certainly has problems. The working class here are struggling to some extent, but there's been a K-shaped recovery here because of the lower taxes, the less red tape. The unemployment rate has stayed steady around 4%. Inflation's below 3%. We're expecting close to 3.5%, maybe 4% US GDP. And the positive earnings, as I said, are helped by the weaker US dollar. So Trump overnight said he doesn't mind a weaker dollar. And that's partly because you inflate your earnings when you bring back. Many of those Fortune 500 companies are generating more than half their earnings outside the US. So it's actually a net positive and it's a tailwind. Just the last couple of slides. This shows if you exclude the Mag 7, then the PE ratio going forward for the S&P is below 20. It's actually around 17.5, 18 times. So there are many, many companies that haven't benefited, Eugene, from the broadening out of the market. The stock market is only starting to broaden out now. We've seen the small caps like the Russell 2000 index finally hitting new highs after a number of years, in fact. The broader market remains far cheaper than once you exclude those Mag 7. And I would just say We don't see a bubble popping anytime soon. We see a positive tailwinds. We think the US earnings are going to impress again, as I said to you, around a 15% year-on-year gain for earnings per share. And the next slide will probably just summarize where we see a soft landing, essentially, in the US. I don't know if you can get to the last. This just shows earnings growth in 2025 and 2026 of around 15%. And then this shows South African fund managers on the global equity side, close to 90 to 93% of them. This is an S&P study recently showing that they failed to outperform the global equity benchmark. So it's been very difficult, not just for American fund managers, but for South African managers. And then this last slide, last but not least, says, expect lower inflation in America. There's no recession. M&A is at an all-time 5-year high. Under President Biden, a lot of M&A was blocked. Goldman Sachs is hiring the largest cohort of new managing directors in their history because of this huge uptick in corporate activity and IPOs and M&A deliveries. And I would just say the lower taxes and tariffs have not actually negatively impacted the US. So it's been positive. And as I say, the Dow and S&P have recently hit record high. So I think we ignore the global markets at our peril, but at the levels of 15 Rand to the dollar, it certainly would seem a good time to be bleeding money into the markets. Thank you, Eugene, for all your support over the years, and happy to take any questions.
Anthony, thank you so much. There was a question earlier on the correlation between your fund, which is the MSCI World versus the ACWI, but I think you did share that slide where the ACWI, underperformed the MSCI World because of emerging market exposure, which caused a bit of a drag. So there's definitely a lower correlation between your fund, which tracks the MSCI, versus the ACWI, right?
Yes. So basically, we've seen most of our clients in America, they want to separately track the developed markets, the emerging markets, and also some non-US markets. Actually, when you look at the non-US markets, until last year, Europe honestly had severely underperformed things like the Euro Stocks Index compared to the US markets. It's very positive and enhancing to see, maybe thanks to President Trump, who we often criticize, because of NATO, the German and the European markets had this fantastic run-up. Rheinmetall, one of the defense stock companies, went up 160% last year almost, just because of the NATO spending. They have something like a $2 trillion gap there in their spending required over the next 4 to 5 years. So it's very encouraging. We remain positive across not just the US, but also in Europe. I think there is more stimulus coming, certainly in Germany. They took, as you know, away that handbrake to allow more fiscal spending. But just to summarize, the fiscal spending in America, there's been a huge impetus of stimulus here. It's not just on the taxes, it's the deregulation that's going on. So it's not all negative in the White House. I know on the geopolitical side, we often get upset and distracted, but on the actual business in America, taxes are lower, red tape's lower. There's a lot more corporate activity than we've seen since President Biden, who honestly had blocked a lot of mergers, had blocked a lot of activity during his term, unfortunately.
Yeah, very interesting indeed, and very healthy numbers coming through from the market as well. And I mean, Trump pushing for GDP of 5% this coming year. We'll see if he actually gets those kind of numbers. But there are some concerns coming through on the labor market. So there's a bit of a wobble on the labor market. And we know that, the AI boom kept up some of the consumer spending. But we do see some pullback in consumer spending because consumers are getting worried about, losing their jobs. I mean, you're on the ground.
Okay.
Is that the feel? Is that the sense?
Well,
among consumers, the normal man on the street?
No, I don't see consumer spending cutting back, partly because interest rates are coming down here faster than you in South Africa. So if you imagine the mortgage rates here are going to be dropping from around 7.5%, 8% some years ago down to 5.5%, 6%. Other interest rates are coming down as well. Trump's trying to now put a limit on credit card interest instead of these usury rates of 27 down to 10%. So actually the interest rates are going to be a stimulus. We have a lot of tailwinds in terms of the Federal Reserve, and he's going to put his new chair in at the Federal Reserve, who's definitely going to cut rates probably once Powell leaves in May. So expect 2 more rate cuts certainly this year. It's all positive. in that respect. By the way, 90% of the data centers being built in America are actually fully leased. So yes, there may be some winners and losers, certainly. There is, some of them may pop like a bubble, but we actually think overall, we are miles from a 1999, 2000 setup. These companies, the Microsofts, the Googles, they've got huge cash hauls, strong subscription revenues. This is not your father's or your early career's internet bubble. It's very different nowadays.
Very interesting indeed. Anthony, a lot of excitement on the new fund, Tech Megatrend Equally Weighted Feeder Fund. I believe that fund's going to launch in Feb. We don't have a final date yet, but yeah, audience, keep in touch with the BCI team. We'll actually communicate as well when that fund launch. But there seems to be a lot of interest for that as well, but we'll definitely keep you posted. Anthony, thank you so much for joining us again. Very late hour for you, always making the time for us. And absolutely effortless. It looks like you just woke up. But thank you so much. Long day for you. And we'll keep communications open. Thank you. Right. Today we will again cover global value, and who better to do so than Robert Secker, Portfolio Manager and Analyst at T. Rowe Price, the equity division, looking at the T. Rowe Price Global Value Equity Fund. Good morning, Robert. How are you?
Hey, morning, Eugene. Morning, everyone. I'm very good, thank you.
Thank you so much for joining us. I think it's your first time on our sessions, but we're very familiar with T. Rowe Price. Maybe just for the audience members, just to create some context, T. Rowe Price was established in 1937. And Robert, correct me if I'm wrong, your AUM at the moment, or total assets under management, is just over 1.77 trillion US dollars. I mean, that is an awful lot of money. Huge company. You manage an array of mandates within T. Rowe Price, but obviously going to focus on global value this time around. Maybe, and again, just for the audience, Robert, you do a lot of research in emerging markets as well, Asia and Chinese equity strategies. So there might be one or two questions from the audience on those sectors as well. But looking forward to your presentation. Thank you so much.
Okay, thank you very much, Eugene. And I'm struck by a couple of points that Anthony made, the previous speaker. First up, how he's excited for the Rugby World Cup. As an Englishman, I'd love to share that optimism. And secondly, he had a point that active is an expensive gamble. Our clients would disagree with that. We run $1.7 trillion of AUM, the majority of which is in active. So we'd certainly dispute Anthony's claim there. So what am I going to talk to you about today? I'm going to introduce to you the Global Value Fund, or just a quick refresher, then onto the market, the opportunities and the risks. So if you could move to the next slide, Eugene. And maybe one after that. Nobody wants to start with compliance. So in summary, what are we trying to do on this fund? This fund is trying to deliver clients value exposure, but doing so in a risk-managed way to minimize and mitigate the risks that come with a very, very deep value approach to investing. So if you think of us, would be a core value, quality value type fund. Now, look at the four boxes there. We have huge resources, as you would expect at T. Rowe Price, with that level of AUM behind us. Our value fund is entirely fundamental, bottom-up driven. It is not a quant-driven process, and we're able to do that because we have a huge team of analysts scattered around the globe, making recommendations, putting them forward to the fund management teams. The fund management team running this strategy have been running it since inception in 2012. And what we are looking for is what we term controversies. Now, controversies to us are opportunities where sentiment impacts valuations, which take it away from fundamentals. So what are we talking about? We're talking about cycles, and we're trying to time the bottom of a cycle. We're talking about management changes. We're talking about regulatory impacts that can depress certain sectors, certain companies, and give us opportunities to step in to those stocks. The bottom left, we're constructing a portfolio of ideas across that value spectrum, tying back to our ambition of delivering consistent value exposure, but doing so in a fairly measured, consistent way. And then the last point there, strict sell discipline. If you're a value investor, you have to have a strict value discipline. there's a real risk of holding on to a stock too long, a value trap. And when you have a huge number of analysts providing you ideas, there's opportunity cost in holding on to stocks that are not working. So we're very active. Turnover is typically 70 to 80% per year. On the right-hand side, as Eugene said, T. Rowe, big EM exposure. This fund limits its EM exposure to 10%, and we've typically run at about 6 or 7% since time began. So next slide, Eugene, please. So when we're thinking about how we create diversification and consistency, we can do so via the traditional methods of sectors and markets, but this is really how we like to think about doing it. So we invest in companies that we really categorize into these three buckets here. So if you think about it, on the left-hand side, defensive value, quality businesses, lower risk, lower return, larger absolute position sizes on the portfolio. As you move to the right-hand side, higher risk, higher return, smaller positions on the portfolio, given the potential downside and losses you could get if our thesis is wrong. So defensive values, the bulk of the portfolio, good businesses, typically in more boring type sectors. T-Mobile, for example, a huge telcos company in the US, been on the portfolio now for the last 10 years. We got it when it was the third or fourth player in that space. Today, it's the dominant player. It's gone through some M&A, rebranded itself. Great market position, great moat. Cyclicals, quality cyclicals we're talking about here. JP Morgan, best bank in the world. It's in financials. It's cyclical. Samsung Electronics, great memory company, the best memory company over time in a cyclical industry. Deep value, lower quality businesses, shorter holding periods, but these are the names that can really keep us going if you have a very, very deep value market. So we're looking for a blend of those names, bigger positions on the left, lower upside, lower downside, smaller positions on the right, higher upside, higher downside. Put it together and we've been able to deliver some very, very consistent performance on this portfolio. Next slide, please. Just turning to the environment. We think ultimately the setup for risk assets remains positive through the course of this year. The sort of government stance around the world is generally supportive. They are erring towards stimulus. That is typically very good for risk assets. Now, on the value side of things, I think it's interesting for us as a US house to note that outside of the US, value has been working in pretty much all markets for the last few years. Since we exited COVID with that huge stimulus that all the governments did through 2020, 21, we've seen value really, really start to perform. And you've seen that notably in Europe. And as Anthony touched on previously, you've got massive stimulus now in Europe as Donald Trump is making us spend a bit more cash on defense. Japan has been working for a number of years now, the reform agenda, and then a politician at the moment who is very, very supportive of risk assets via her stimulus policies and her monetary policies. And emerging markets have been doing well. You can notice the last couple of years, value has actually underperformed growth, but that is very much tied to that dynamic you're seeing in the US. US driven by Mag 7, driven by AI. What's done really well in EM in 24-25 has been those AI enablers, which are growth stocks really, TSMC. So the setup for equities is good. The setup for value, we think, remains very good as well, as we'll come on to. Now, Eugene, next slide, please. Thinking about how we traditionally get diversification. We are truly global. We go anywhere. We find ideas in all sectors. The sector chart there on the left, as you would expect, with a value bias, we find more opportunities, financials, materials. Healthcare is a new addition, typically a defensive type of growthy, quality, expensive sector. But given Donald Trump's actions this time last year, we had opportunities to step into that. Underweight tech, again, as you would expect, given the composition of the index and the skew towards those big US hyperscalers and AI-related names. The chart on the right-hand side is a good one to note. Our underweight to the US, we've consistently been underweight to the US, as you may expect if you're a global value fund. But the point here is that our overweights, underweights are capped at plus or minus 10 at a market level, except for the US where it's plus or minus 20. That enables us to deliver consistency. Many deep value funds really do go very, very light in the US and will be underweight the US by 50, 60%. That becomes the main risk factor, the dominant driver of their relative performance. We will be underweight the US, but not to the extent where that bet simply drives our relative performance. So stepping forward a slide, Eugene, onto more exciting areas. Where are we seeing opportunities? So when we look at this, we've got these nice graphics here. Really, we're a bottom-up driven fund, but these are the pockets where we're finding lots of opportunities today. So why do we like commodities? Well, we like commodities because fiscal stimulus is continuing along across the Western world. Defense spending picking up huge in the US, huge in Europe. All of this is leading to big fiscal deficits, which is leading to currency weakness. And ultimately, commodities, precious metals particularly, are a direct beneficiary of that. And we saw it first. Gold started to run and to work first. That's always been the case. Then it moves across into other metals. And more recently, I'm sure it's not passed you by, silver has gone through the roof over the last 6 months. So we think there's more to run on that as currencies become under pressure because of huge fiscal stimuluses that are being carried out pretty much across the globe. Commodities to benefit from that. Turning to financials, we're in a world where negative interest rates are a long forgotten thing. Capital has a cost. Rates are at a level where banks can make money. But I think surprising to the upside could be inflationary risks. Again, tied to fiscal stimulus, tied to deglobalization, tied to tariffs. These are all inflationary policies. Inflation, higher rates, good for financials. Healthcare, again, demographics suggest more money is going to be spent on healthcare. And what's interesting, you look at the US, they spend double the amount GDP amount per capita than Japan, but their life expectancy is far, far shorter. Donald Trump really went after that sector about a year ago, trying to cut the costs, trying to reduce pricing. The whole sector came down. When a whole sector moves down because of a top-down factor, that's when we can step in, use our analysts to uncover ideas. Energy, on the right-hand side, we think where the oil price is today, the marginal producer of oil is not really making money. Saudi at current levels are not actually making money when they're pumping. So ultimately, we think supply will ease, demand remains strong, so we should see upward pressure on energy. Been pushed out a little bit because Trump is drill, baby, drill and keeping it going, but medium to longer term, we see a lot of opportunities there in the energy space. Now, T Rowe, known as a growth house, our analysts work for growth PMs, but we also run over 200 billion in value strategies. That means our analysts are covering growth stocks and value stocks within their sectors. And that's really important for us running a value fund because we see all of the upside that AI can bring and benefit our growth managers. But from our perspective, it's more about understanding how AI could create value traps, could destroy terminal value of businesses. And just over there on the left, we've got a nice little graphic about automated self-driving cars. We had a shift towards EV. That has led to a huge sell-off in traditional car manufacturers. We've managed to start some positions in those names at 0.3, 0.4 times price to book because this huge sell-off, because everyone is assuming that the traditional car companies are going bankrupt, right? We don't necessarily see that's the case. I think more interesting is over there on the right-hand side, our graphic to really represent software and the impact from that. So we've sold out of a company that you'll be familiar of, Salesforce. Why have we sold out of it? Because AI enables companies to create their own software. That is a huge headwind for pure software businesses. It's also an opportunity for IT services as well. That whole sector has come down. We see, again, some opportunities because some IT software, IT services companies will actually be implementers of AI systems into their customers. But again, the whole sector has got moved down. So we really have to understand where AI is going to disrupt businesses to understand if it will impact their terminal value or potentially step in to take that risk if we think the risk reward is on our side and AI won't completely destroy their business model. So just moving toward the end here, when we think about the setup for value, what is this chart showing us? This is showing us the growth versus value premium for the US in terms of Russell, and EFI in terms of representing international markets. And obviously growth always trades at a premium to value. That's very much in the definition. You can see where we are on the right hand side, the current spread. Yes, value has been working for a period of time now, but you have to understand where it came from. A huge period of prolonged underperformance. Value's working, but remains cheaper relative to growth than historically has been the case. So value still looks good value will be the message there. And then just to conclude, Eugene, on the last slide, I think when we look at it, the setup for risk assets is good. The setup for value is good. We think clients are overly allocated to the US, over allocated to growth. We're beginning to see clients allocating away from the US, allocating away from growth. We think that trend will continue. That is good for value. That is good for global funds. It's point there in the middle, the bottom line, just to really echo on what Anthony said. Active management is really key, particularly at a time like today. Huge level of volatility and huge uncertainty from AI. There will be winners, there will be losers. You need to pick your argument and find out which one are gonna remain. And then, just as I said, the outlook for value remains very, very supportive, and we are exceedingly confident in the outlook for value and indeed the outlook for this fund. And I'll stop there.
Robert, thank you very much for that. A lot of things to think about, especially if you're trying to run a well-balanced portfolio or diversified portfolio for clients. Definitely need to think about value. And if the audience buy into value and thinking I should diversify a little bit more, including a value fund, why T. Rowe Price?
Yeah, because I think perhaps the easy money in value investing has been kind of made. You've had a deep value run. The deeper value pockets moved very aggressively coming out of COVID. I think the style leadership rotation will perhaps be more muted going forward. So what we are giving you is, if you like, light value exposure. So if growth suddenly starts to reassert, we will try to keep up with that market. We won't be left entirely behind. But when value is delivering, we will capture that as a tailwind. And that's what you can see in the history that we've delivered over the last 12, 13 years. We will deliver performance somewhere between the value index and the core index. So a cautious step into value investing would be how I'd phrase it.
Very well put indeed. Just quickly, you briefly touched on Japan. From a currency perspective, I mean, the yen stands out as the currency that can probably be the biggest winner again for 2026, massively undervalued. And especially with the changes in the US, the dollar being under pressure. You also mentioned, flows of capital out from the US into other areas. But despite the yen that offers attractive valuations, are you finding really good companies at trading at discounts in Japan that you also house in the fund?
Yes, certainly we are. We don't worry too much about currency. That's not our skill. Our skill is understanding businesses, and sure, we understand currencies are a part of that, but we don't make allocations based on currency predictions. The Japanese market is ripe for active management. It's going through a huge period of reform, some really exciting companies, some really exciting management teams, a step change over the last 5 years in terms of their appetite and attitude towards running their businesses to ultimately drive value creation for shareholders. So a market that we love, a market that we've been overweight now for a good period of time, and a market we continue to find a lot of ideas. And of course, at T. Rowe, we have a number of analysts based in the region. We have a Japanese PM based in the region. So we always have boots on the ground in every market, uncovering ideas.
I think the part that also sets you apart is those teams in all the different regions as well, where you tap into Very last question, you did mention energy as one of the sectors that you focus on, but more specifically on energy, what about things like nuclear?
Yeah, we don't have any exposure to nuclear on this fund. I guess when I look at our energy exposure and what we're playing oil integrated majors. We've got a few E&P companies, and then we have oil services is the sector we've got most excited about. So yes, nuclear is attracting a lot of attention, particularly in Europe, as a way, I guess an easy step between fossil fuel and renewables and clean energy, but we're not playing that yet. It's fairly limited in terms of its investment landscape and opportunity. We're finding much more opportunities in traditional energy.
Robert, thank you so much for sharing insights from T. Rowe Price and how you run the value funds and where those opportunities are. And again, if you're looking for a good balance in a well-diversified portfolio, definitely a fund worth considering. Thank you for joining us this morning, and we're grateful for your time.
Pleasure. Goodbye.
At the ready to go, we've got Ben van Leeuwen from Lindsell Trade. Thank you, Dan, for that. Lindsell Trade is a company that focuses on looking for opportunities or companies with strong return on equities that compound over time. Ben, thank you so much for joining us this morning all the way from London with an update on how you see the world and these opportunities manifesting in your fund.
Brilliant. Thanks, Eugene. I'll just try and share my screen now, if that's all right. Okay. You can see the presentation okay?
I can, if you could maybe, there's full screen mode now. Perfect. Thanks.
Thanks, Eugene. All right. Well, I'll try to leave some time for Q&A at the end, but here are the usual disclaimers. Please read at your leisure. Thanks for having me. Today, I'm going to briefly give a little overview of the fund as we currently see it. And then quite excitingly for us, we do have 3 new names to discuss. So I will go over each of them in brief in an accelerated fashion. And then I'll end up on the portfolio so that we can discuss any other factors as they come up. This is always my favorite one just to start on, which shows the history of the strategy since inception. New names are above the line with green to denote buys, and sells are below in red. And as you can see there on the very far right, over the last 12 months or so, we've managed to recycle some capital out of Astellas, Hargreaves and Cal into these 3 new names that I'll be discussing today: Thermo Fisher, Alphabet, and Games Workshop. Despite this turnover, some of which was forced upon us, Hargreaves was taken private. The long-term turnover is still under 5%. So we maintain our long-term implied 20-year holding period, which is a very important part of the strategy. And just as a brief reminder, the reason we think we can do that, and we think we should do that, is that when you find companies with these high and sustained returns, the compounding you can get from them will allow you to tolerate even declines in valuation and still lock in superior returns. So as ever, we always stress to look at the returns the companies can earn rather than the multiple they happen to be trading at today. And this just shows the history of the strategy, again, since inception relative to the index. And as you can see, the companies we've found and managed to hold on to, many since inception, have maintained that quality differential versus the index. They were good companies, they remain excellent companies. And yet, as you can see there on the right, despite the index's inferior returns and margins and many other factors, performance has narrowed. And that is largely a re-rating on the part of the index, driven by a very concentrated number of names. I don't propose to spend ages on that particular factor, but I do just mention that re-rating element because here you can see the history of our strategy one last time for the individual names. And it's a total return breakdown, each with a unique starting point from when we first bought them. And this is not every single name, but this is the majority of our names. It's the top 85%. And what you can see at the very bottom, which is the unweighted mean and the summary, is that the key driver for us has been the underlying earnings growth and very much not the change in PE multiple. So throw in some dividend yield as well, and that gets you to your low teens, which is what we continue to target and what we will continue to focus on regardless of whatever is happening to the multiple change of the index, which fluctuates as it may. Great. And now, as I said, turnover is rare, but we do have three. A lot of work goes into these names, but I will try and race through them as quickly as possible. The first is Thermo Fisher. It's a life science tools company. So basically, it sells services and components and equipment to pharma companies, pharmaceutical companies, and it helps them discover and test and measure and roll out new drugs. We think it's a great sector. You've got a number of nice tailwinds. You've got an aging population. You've got a very healthy pipeline of new drugs coming through, which are increasingly skewed towards higher value, more complex drugs, namely biologics. And you've got fairly dependable government funding. So very nice growth tailwinds. You have some very nice business models hidden within the sector. On the regulatory side, every time you file for a new drug, you tell the FDA what equipment you used, and then you're obliged to use that same equipment for the entire life cycle of the drug. So that's instantly multi-decade surety tied in. You sell high-value components like reagents and consumables to feed your machines. That's a very nice kind of recurring subscription, high-margin model. And these are high-risk, high-value contracts, and they're tied in for many years. The other great thing is that you don't worry about which drugs may or may not get approved. As a life science tools company, you're fairly indifferent. That's a stress for the pharma companies instead of you. You're sitting at a different point in the value chain. And then within the sector, our pick is Thermo Fisher. It has this unique span across all of these different pillars within the overall industry. It sells the consumables, the instruments. It is a CRO, a clinical research organization, which means it helps organize clinical trials. And it's also a CDMO, which means it basically helps manufacture your drugs for you. So if you were to think of the entire life cycle of a given drug, Thermo Fisher is basically the only company out there that can offer a product or a service for every stage in the life cycle, which has tremendous value to its partners and explains why this is a current, an ongoing share gainer, regardless of the environment. It had a fantastic COVID, sadly, for the world. There was then a bit of a demand shortfall, and then we've seen a bit of a rebound, and we've managed to buy it at pretty attractive prices throughout that period. The next one probably needs very little introduction, but it is Alphabet. We managed to buy it again at a very nice juncture when these were the headlines, which, not long after has already seemed to reverse, and Alphabet is now perceived very much as an AI winner. But this is it. You have to be ready and willing and waiting for these opportunities and have the discipline to do so. This kind of history is what gave us the conviction to act when we did, which basically just shows over the last 20, 25 years, the company has been preparing for exactly the current environment that we're in. So when others were slightly spooked, we could fall back on this history. And I think it's just a fantastic quote there from Larry Page on the far right. Artificial intelligence would be the ultimate version of Google. And he was saying that in the year 2000. So they are not caught with their pants down here at all. This is also the key slide for us. Of the major hyperscalers, the Mag 7, of the major tech players today, Alphabet is the only one with presence across all 4 layers of the AI stack. It has proprietary silicon at the bottom, which means it competes with NVIDIA. It has the leading research lab. It has one of the best LLMs. And crucially, it has the best distribution with 7 products there, like Android and emails and YouTube and so on. So just a phenomenal, powerful reach across the board. And just to kind of bring this prescience to life. That team there on the left are some of the core team from DeepMind. Alphabet acquired them for 400 million back in 2014. And just to put that in context, last year, Meta paid 1.5 billion for a single employee for 6 years worth of wages. So that just puts it into context. And I shudder to think how much you would have to pay Alphabet today to acquire the DeepMind lab. But lucky for us as shareholders, they already own it. Just to finish briefly, we think rumors of Search's demise are much exaggerated. We're not seeing it in the data. Search is definitely evolving for sure, and there are some new players. But AI should not be a massive step change. If anything, there could be new monetization opportunities and accretive changes to Search coming. And there is no one better positioned, as we've already discussed, than Alphabet to go after that opportunity. But at the same time, please do not forget that there's a whole other side of the business, which is nearly 45% of revenues now, including Google Cloud, YouTube, all of the subscriptions and so on, that in and of itself is growing at a very comfortable 20% CAGR, which often gets neglected. So all in all, a fantastic business. It has seen some re-rating since we first bought, but it has a number of exciting opportunities ahead of it. And then just to juxtapose Alphabet with one you probably haven't heard of, this is Games Workshop, which is a fantasy figurine manufacturer based here in the UK, and much smaller market cap, but no less exciting. I've included this side by side just to show that we do the work, and often it takes many years before we buy a single share. On my left is my colleague James visiting the headquarters of this company back in 2016. On the right, that's James and I visiting their new flagship store in Tokyo. Over the interim, we've written many, many notes, met with the management team many, many times, but we did finally invest. But it can take us a while. On the right, there are the kind of figurines that this company makes. And I've included a quote about alchemy because it's a very beautiful business. They take commoditized plastic, they put it through a specialist mold, and they sell the result at a huge, huge premium, which earns them these kind of financials. 70% gross margins. The return on capital employed has only dipped under 100% once in the last 10 years and grown very comfortably still in the mid-teens. Just a beautiful, beautiful set of results. This is how it makes money. It sells primarily through trade partners. It has its own retail stores as well. And then there's an online and licensing bit. And if you look there on the top right, we think there's still a lot of scope for them to expand their trade account partners. That will be one of the key drivers. We've just done a little back of the envelope here. If you assume, which we don't necessarily, that they're saturated in the UK in terms of the number of their own stores per the current population, you can then see what that level of penetration might look like for North America, Europe, and Asia. And as you can see, there's a nice long store rollout volume game ahead of us. But then you've also got the licensing business, which you'll remember was only 10% of revenues, but is obviously pure profit. That's them licensing their content to video game makers and publishers and so on, and just collecting their coupons. And that has grown at a 43% CAGR, and we're just getting started there. But just to put those figures in context, the licensing revenues essentially mean that they take a 10% cut from their partners. So that means by extension that there's almost £500 million of revenues being earned by the overall Games Workshop ecosystem, which is not far off Games Workshop's total revenues today. So there's still a huge value pile out there for them to go after. But then finally, forget the stores, forget licensing. We still think there's a huge opportunity for them to grow their fan base. They only have maybe 1 to 2 million players today in terms of the physical objects themselves. They do have some more digital players. You see that on the top right. 7 million people play their video game. But if you compare this to other similar niche collectible / gaming franchises like Magic the Gathering or Dungeons and Dragons or even Lego, there is still a huge addressable market for them to go after, which they are doing very successfully. And we look forward to them converting that. I'll pause here very briefly. This is the portfolio as it stood in November. As you can see, Thermo Fisher there is now our largest consumer and healthcare franchise. Alphabet is our largest holding in media and software. And Games Workshop took us longer to build a position, but it is still an important component. But this is very much the direction we see ourselves going in: high quality, current revenue, defensible IP at a misvaluation at time of purchase. So thanks very much, and I'll open up to Q&A.
Ben, thank you very much, and very interesting indeed, some of the companies that you find at the moment. And I mean, from selling figurines and making revenue of £629 million. I mean, who would have thought that those kind of businesses still out there? Very exciting indeed. Ben, I'm going to get to the elephant in the room. Lindsay Train gone through a very tough period over the past 2 years. I know Nick has got an outstanding record for the past 25 years. But I think, you know, with any fund manager, if you go through tough periods, you have to think about, you know, are we still on the right path? Are we still doing the right thing? Do we change strategy or not? You've shown in the past that you are able to find those companies that does compound extremely well over time. What are your views within Lindsay Train now? Are there doubts on the process, or are you sticking to your guns?
Yeah, that's the key question, really. The short answer is that the process remains entirely unchanged. The kind of companies we're finding today maybe have slightly evolved over time, but that's only natural. If you look at maybe the last 5 years, we've bought into life sciences, we've bought several information services companies like FICO and Alphabet. We've now bought some more content companies. Maybe there's a slow and gradual evolution, but the guiding light is always the highest quality companies we can evolve into. And sometimes that does mean selling out of a Japanese pharma company and buying into a company that has achieved a return on capital above 100% for more than a decade. I think over the last few years, there were some challenging cases where we've had a very strange derating in certain corners of staples, like in spirits, and also large holdings for us, like the London Stock Exchange Group, being perceived as an AI loser, which we think is wrong. But you know, this is the beauty of a concentrated approach. You can go through periods of pain, but then you look at holdings that we've held since inception, like TKO, where it can have multi-year minus 50% drop downs, but still compound at a high teens rate. The key is just not to be shaken out and have that longer rolling 5-year perspective at the very least.
I think very valid what you said, and more recently, I know the Finsburg Growth and Income Trust had a board meeting, and they, to vote to retain Lindsay Train or not. And I mean, there was an overwhelming vote, I think 97, 98% of trustees to vote to retain Lindsay Train because of your outstanding record and what you do for clients over time. And I think that's key to investment strategies like this. You know, if you find good companies that does compound over time, you've got to allow them to do what they need to do.
This is it. We'll continue to do that, we hope.
Exactly. Ben, thank you so much for your time this morning. It's always great to have you on board with the update on what's happening on your fund. But let's see, 2026, it might very well be a very good year for you if you look at some of your underlying holdings. Let's see what happens. Thank you so much.
Thanks, Eugene.
Right, we are going to continue now with a quick update from Sands Capital. We're going to look at global growth, specifically in emerging markets, managed by Sands Capital. And here to share the views with a quick update is Dave Levinson. Thank you.
Hello, everybody. I'm Gabe Levinson, a portfolio manager at Sands Capital Management. It's good to see everybody today. Welcome to the webinar. Sands Capital is a privately owned specialist investment manager with a sole focus on long-only growth equities. We were founded in 1992. We're headquartered in Washington, D.C., and we have offices in London and Singapore. All we do is growth, no credit, no value, no distraction. We only answer to our clients. We have no external stakeholders or shareholders to please. We're entirely owned by the people who work here, with the Sands family owning about 70% and senior staff owning the balance, with this mix expected to increase over time. We do only one thing. We look for growth businesses and own them for the long haul in concentrated portfolios. We apply this approach across the capital structure from venture capital to public equity, and across the world, from the US to developed markets to emerging markets. We have both global growth and emerging markets growth on the platform. I work on global growth, so my comments will reflect that strategy specifically, but are broadly applicable to both strategies. Our flagship global portfolio has an unconstrained opportunity set in terms of looking for public companies that meet our criteria anywhere in the world. And what sets our approach apart is this business owner's approach to investing in public equities. We are focused on long-term earnings power. We want to own only the best and ignore the rest. The trajectory of earnings per share growth is more predictable than swings in valuation, which can be random and unpredictable, and our time horizon is aligned with this approach. We want to give our businesses 5 years, often much longer, to enable the ability of earnings to compound. A longer time horizon also typically means less distortion from less fundamental factors. When we look at this chart, it breaks down our long-term investment results into two key factors. The first one is the change in profit growth, indicated by the dark blue bar or dark blue line. And the second factor is the change in valuation, indicated by the light blue bar or the light blue line. As you can see at the bottom of the chart, in any given year, either profit growth or valuation changes can be the bigger factor in driving results. But as we stretch that out over many years, it becomes obvious that profit growth is the overwhelming factor driving value creation over time. When we look at our long-term rolling results, you can see that over longer periods of time, so 3 years, 5 years, 7 years, 10 years, we are able to add value in most time periods as we execute on our mission for clients. Since it's early in the year, let's talk a bit about what's exciting from here, how we're positioned, and what 2026 and beyond might bring. We aren't thematic investors, but you see on this page a handful of themes that are present in the portfolio today. Demand aggregators is a great one, whether it's what kind of music you want to listen to, what you might want to watch in video form, a TV show or a movie, what concert or event you might want to go attend, or maybe what kind of food you want to get delivered. These sorts of businesses like DoorDash and Netflix are demand aggregators where consumers go to these sites and then decide, how do I solve the problem at hand, food delivery, whatever. One of the big trends, obviously, is AI, which powers about a third of our portfolio directly. So let's dig into that in a little bit more detail. We'll look at a few charts here to kind of flesh out what we're talking about when we think about AI. The first chart here shows you what is called scaling laws. And to break this down into simple terms, it means as the amount of compute power is applied to answer a question, solve a problem, automate a process, the answer becomes better and better and better the more compute power we have at the problem. This should be good for companies that make the chips that power that compute power, such as NVIDIA, the companies that stitch that together and make it accessible, hyperscalers such as Google or Amazon. We can also see here some big differences between what's happening today with GPUs and data centers and what happened 20 or 30 years ago with the deployment of dark fiber in the world. GPUs in data centers are being used about 80% of their capacity, so used all the time, all day, every day. And back in the old days when fiber was going in the ground, the cost was really digging the trench. So you dig a trench, and once you've incurred that cost, you drop conduits in the ground, and instead of putting one fiber in the conduit, you put 1,000 fibers. So the utilization was much lower. And once the deployment happened, you could light up that fiber over time and create more capacity, which is very different than what's happening with GPUs today. Thus, the demand for more and more and more GPUs is expected to continue. We can also look at what happened with the Magnificent Six, so the Mag 7 excluding Tesla, and see what's happened with their operating margins, which are the blue line at the top, steady and starting to rise, and what's gone on with headcount growth, which are the dark blue bars, which were quite robust for many years and have started to come down over the last few years as the power of AI has rolled through their business. So more compute power, fewer people, higher margins. When we look at this chart, one of the obvious drivers at the very top for demand for AI tools and services is, can I earn some sort of financial ROI when I use AI for a project? This example shows you Meta's new tools for advertising targeting called Advantage Plus, and you can see really big increases in incremental revenue accruing to Meta, and a similar type of a thing for other companies that do advertising digitally, as well as more revenue generated for the advertisers. So examples happening today in the real world in a really big way of companies using AI tools and services to create a new service or enhance it. The next chart here, a lot of concerns about financing, circular financing happening in the industry. Very, very small today. Most hyperscalers have huge balance sheets and can accommodate the financing that's happening in the world. Lastly, what's going on with infrastructure providers today versus in the tech bubble from almost 30 years ago. Here's a chart showing you the difference between NVIDIA, which is one of the big chip providers of today for AI, and then Intel, which was one of the big chip providers for personal computing and things of that nature back in 1999. You can see in the case of NVIDIA versus Intel, NVIDIA much higher revenues, higher margins, higher returns on equity, and much, much higher net income as a function of that. So what this shows us is for these large companies that are enabling AI today, they have enormous financial wherewithal to spend money on these tools and services. And as we think about the beneficiaries of AI, we own companies all across the spectrum here, from infrastructure enablers such as TSMC, who creates the chips, NVIDIA, who designs the chips, builders who put these chips together, such as Amazon or Alphabet, and then companies that use AI to create new tools and services to sell to their customers, but don't invent AI, companies such as Axon and ServiceNow. So that's quite a bit about AI, but it's a big deal in the world today and an important part of our portfolio and an area where we're very excited to own both the enablers, the builders, as well as companies of all shapes and sizes that will use AI to create growth opportunities or widen moats for themselves. But all of technology is not growth, and not all growth is technology. We have plenty of other businesses around the world that meet our growth criteria and are neutral or maybe agnostic to AI. We want to outperform over rolling long-term cycles, so we don't want to concentrate too much in any single theme or driver. And that's how we end up with a portfolio of semiconductor businesses, Canadian discount retailers, Indian banks, US roofing manufacturers, and even European ticketing platforms. And so now is a really interesting and attractive time for the global growth strategy. As you can see in this chart, where the dark blue bars represent global growth and the light blue bars represent the benchmark, the ACWI, over 2025, the strategy global growth delivered excellent earnings per share growth, up about 22%, while the benchmark delivered earnings growth of about 16%. But global growth experienced significant multiple compression. The valuation of our portfolio was down about 9%, while the broader market's valuation was actually up about 4%, which led to the results trailing the benchmark during the year. And as you can see in this chart, which is the same dynamic, the dark blue is the earnings growth change, and the light blue is the valuation change, with the orange dot being the total return for each company. Many of our companies, almost all of them, delivered very strong earnings growth, but about 2/3 of them had their valuations compressed during the year. And in this chart, you can see some of our highest conviction holdings, 5 of them here. The dark blue bar shows you how the investment results were, the return was in the first half of the year. And the orange chart, the orange bar, shows you how they did in the second half of the year. So a big reversal, and really largely related to the underlying fundamentals of the business. So just major reversals in what the market thought about the stock price of these companies. We continue to own all of them as we expect ongoing robust growth and value creation over time. And then finally, this has resulted in a portfolio that trades at the lowest premium to the market since 2009. Earnings growth continues to come through, yet valuations have continued to compress, and we think this points to opportunity ahead. So I want to thank everyone for tuning in today. We really want to thank you for the partnership, and I look forward to speaking with you later in the year as we check in on how this valuation compression opportunity has played out. Thank you very much.
Right, at the ready to go, a man that needs very little introduction, Greville Ward from Fundsmith, waiting very patiently. Good morning, Greville. How are you doing?
Very well, Eugene. I'm the last speaker, which means everybody's deeply confused by this stage. Half the speakers have said buy, half have said sell, and nobody knows what to do. And nothing I'm going to say is going to help that. So I apologize in advance.
Greville, again, thank you for your time. I believe you back at home in Mauritius. I do have to convince Robert sometime to come and buy you lunch in.
Please. Everybody's welcome. It's a beautiful place and it's easy to get to. And I'll buy you all lunch if you come here. Happy to do that.
Yes.
Okay, I've got some slides which you're going to very kindly put up for me, I believe. But yeah, for those that don't know, I'm Greville Ward. I'm going to talk about the Fundsmith Equity Fund and also some sort of broad things that are going on in the world, many of which you may have heard about today already. Let's go on 2 slides so that we'll skip the disclaimer. So last year was a difficult year for us in sterling. It's a sterling-based fund. The simple reason why the fund didn't do particularly well last year was that the market didn't really want what we own. The top 5 sectors in the S&P last year were communication, information technology, industrials, financials, and utilities. And the worst 5 were real estate, consumer staples, energy, consumer discretionary materials. And healthcare was sort of in the middle of those groups, if you like. And we invest in some technology companies, which we'll talk about in a minute, but we also invest in consumer and healthcare. And in simple terms, investors wanted sex, drugs, and rock and roll last year again, and that's not really what we do. So let's move on and talk about some individual reasons. Right. So this slide shows the concentration, which I know other people have spoken about, but we're just trying to show that in the last 5 years, more than 55% of the return has come from about 30% of the S&P. And that concentration means should be an opportunity for active managers like us over time, because it allows us to seek around in the unloved stocks, if you like. And we certainly have been doing some of that. But this trend does not show, well, it shows early signs of abating somewhat. but it certainly has been going on for some time, where all of performance has been concentrated in a very small number of stocks. If we just move on another slide, you will see that now 35, actually a little bit more than that, of the performance of the S&P comes from the largest 10 stocks, 18% for the top 3 stocks and 7% from the largest stock. To give you some other slightly concerning or possibly slightly concerning statistics, the S&P TMT market share is as high as it was during the 1990s tech boom. The combined weight of stocks with a 3% weighting or higher in the S&P is at a record high, about 30%. The top 10 companies' share of S&P earnings is at a record high. The top 10 stocks contributed 55% of the S&P market cap gain since the 1st of January 2021. And the price to sales ratio of the S&P is at a new high at 3.5, and the average P of the top 10 stocks in the S&P is around 50. So this is an unusual period. Maybe it'll go on for some time, we don't know, but that concentration has some fairly serious kind of underlying effects, if you like. Let's move on. Something else which has been injurious, I think, to active managers and global growth managers such as ourselves is that now more than half the market is owned by passives or by indexes. And clearly, given all the concentration statistics we've just run through, every new dollar that goes into an index fund or an ETF is going to be, a portion of that is going to go towards the top 10 stocks. So one of the things that we say about passive strategies is that they're really momentum strategies, because for as long as everybody's moving money from active to passive, which on those charts you can see has been happening, then this is all well and good. But it's a sort of a self-fulfilling momentum trade, if you like. More and more money going into the larger stocks, the concentration increases, and that's all fine for as long as it's fine. But the question is whether or not the retail investors or those investors moving from active to passive will be patient if the market goes through a correction. But I think that again, a high concentration of passive investments should give active managers an opportunity at some stage, because obviously index funds are investing without any regard to either underlying quality of the assets or price. Okay, let's move on. So something else which has clearly affected us, or those that own our sterling-based fund, is that the sterling dollar rate moved from 122 roughly to 135 or so, today around 138. Just of interest, we have a feeder fund that feeds into our UK fund, which is priced in dollars, and that was up 8.3% last year. So 8 points different in performance between sterling class and the dollar class. We're certainly not going to make any sort of currency predictions. On the one hand, Trump says that he wants a stronger dollar, but then he also wants interest rates to come down. He also said publicly yesterday, when asked about weakness of the dollar, that he didn't really worry about it, wasn't really concerned about it. So not quite sure where this goes, but clearly in the short term, if you have 70% or so of the portfolio in listed US stocks and you're a sterling-based fund, it has been injurious. We are taking some action within the portfolio to slightly reduce our dollar exposure on the basis that this could continue for a little while. Let's move on. So this is the hyperscalers spending money. And again, other speakers have spoken about this, but it is a vast amount of money which is being put in to data centers principally because of AI. And our only concern there, our only thing that we are monitoring is that we are all about return on capital. And we need these companies, or those that we own on that page, to make a meaningful return on these vast amounts of money they're putting into these projects in order for us to think that they are going to go on having a return that we think will sustain and that we want to invest in. And the jury's still out on whether they're able to do that, just because The numbers are so big. The question is whether or not people are going to be paying for large amounts of money for their AI access, or whether the majority are going to use either a cheap version or a free version. And in that whole kind of game, who wins and who loses? And you could say with companies like Meta that maybe a lot of their spend is to improve and enhance their underlying business and their advertising business and so on. So maybe that's easier to stomach. But these $389 billion this year is an incredible amount of money to spend. And unless they can get decent returns, then these companies' overall returns for their businesses and possibly their valuations may suffer. So this is just something that we're keeping an eye on, but it's a very important question to ask at the moment. Are they going to get a return for these billions and billions of dollars that they're putting into data centers? Okay, let's move on. So things that worked for us and didn't work last year. Alphabet, previous speakers will be speaking about that. IDEX is in veterinary testing. Philip Morris is doing well in its heat not burn category, or reduced risk products. In fact, the amount of the Philip Morris business that is sales generated from non-cigarettes, if you like, is getting quite close to an inflection point where it'll become, the reduced risk products will become bigger than the actual cigarette business. Meta Platforms and Microsoft on the other side, and the only one that I was going to mention briefly is Novo. I've spoken about it before. Everybody knows what they're up to in weight loss drugs. I mean, the stock is up 30% since mid-November last year, because they have now released the Wegovy pill. And for people who want to lose weight safely and don't want to inject themselves, there is now a pill that they can take. It's a complicated area, weight loss, because absolutely everybody's trying to get into it. And Novo clearly lost out to Eli Lilly in the US in the last couple of years. And still a little hard to see who the ultimate winners of all of this is going to be. But there's no denying that this is an enormous new market for pharmaceuticals. And at the moment, Novo and Eli Lilly are the only two with approved drugs. Let's move on, if you don't mind. We are here. So as mentioned by me and also previous speakers, return on equity is what we think is the most important measure of whether companies are doing a good job. And we believe the Fundsmith Equity Fund, the companies that we own, the 27 stocks that we own, are excellent businesses. You know, the stock market may not be reflecting that at the moment, but we think they are really good. And on average, they have return on equity of 31% or so, down just a fraction from last year. That's probably because of the AI spend from the 3 Mag 7 stocks that we own. But still, these businesses have fantastically high gross margins, high operating profit margins, very good cash conversion, and much higher interest cover, sorry. And in all of those measures, significantly better than the S&P and the FTSE. And that is what's kind of key to us, that these businesses are clearly better than the index. And at some stage, we think that that will be reflected in the way that they're rated. Let's move on. This slide is, I'm going to show you that the valuation of the portfolio, the Fundsmith Equity Fund trades on free cash yield of 3.7, S&P non-financials trades at 2.8. This is the lowest valuation relative to the market that the Fundsmith Equity Fund has traded on for 8 years. In fact, we usually trade at a premium to the market because we own better companies than the market, as demonstrated by the previous slide. But at the moment, we are trading at a discount because the index has done so well, particularly in those concentrated names. But you'll see underneath that the average free cash flow growth of the companies we own was 16% last year. It was actually 14% the year before. So there's nothing we don't like about the stocks that we own. They are doing very well. They are growing their earnings, they're growing their free cash flow. They have high returns on capital. And we believe that if they go on growing and compounding at the rate that they have been and look as if they can continue, that at some stage that will be reflected in their valuation. As mentioned at the beginning, they are in sectors, 2 of the 3 sectors that we are invested in, consumer and healthcare, were not particularly popular in the stock market last year, and that's why the fund didn't do particularly well. But this is the cheapest that this fund has been relative to the index for the last 8 years. So we do think that we like where we are, much as it would be good if the fund had produced a better return over the last 2 years. And I think I've got one more slide, which is, if we can go to that one, which is, yes, even though we're a buy and hold fund, we do take action when we have to. And in 2025, we sold PepsiCo and Brown-Forman. Brown-Forman was the last of the spirits companies that we own. We sold Diageo in 2024. We think that spirits manufacturers have an issue, two issues actually. One is that younger people are drinking less, and that's a whole topic for another day. And the second reason is weight loss drugs. People on weight loss drugs generally drink less, and more people are taking weight loss drugs. So that's why we sold Brown-Forman, we sold Diageo last year. PepsiCo, similarly. Pepsi, the drinks business is fine, but they make salty snacks, and that is not a particularly good food category, with an increasing number of people trying to lose weight or taking a weight loss drug or having reduced appetite for food. And then on the left-hand side are things that we bought: Intuit in small business software, which we've owned before actually, Zotis in pet medication, Essilor-Luxottica in eyeglasses, and obviously joint venture with Meta for smart glasses, which we're interested in, Altus Klure in sort of digital publishing, online databases for healthcare and legal and things like that, and Magnum Ice Cream, which is a split-off from Unilever. So we it sort of inherited that. We didn't actually buy into it, but we continue to own it at the moment. And that's really all I'm going to say. I mean, we are going to continue to buy and hold really good companies, excuse me, that we know can grow and compound every day, irrespective of what's going on in the global economy. We can prove that they are growing. We can also prove that they have very good returns. We totally understand that they've not been very popular in the stock market, but we think it would be a mistake at this stage to change our strategy and just rush off and follow momentum or try and buy things because share prices are going up. We would rather buy and hold really good businesses and believe that at some stage the value of those businesses will be reflected in their price. So that's what we are doing, have been doing. We have expanded. The research department at Fundsmith is looking outside some of our usual areas, both in terms of sectors and also geography, to try and find other companies which have the quality thresholds that we look for, but might be interesting for the next sort of 5 to 10 years. So that is an ongoing project, which is already bearing some fruit, which is interesting. But in the broadest scheme, we're going to continue to do what we do, Eugene, and we're not going to make any drastic changes. That's it.
Very insightful indeed. And the one slide that you showed there with passive exceeding active, and I mean, you know, it's almost becoming a self-fulfilling prophecy, as long as things remain good, and that's the big question. But maybe more specifically on AI, and I mean, Sands Capital, that touched on it very briefly with their recording, and on our session last week, Jared Khan from Credo also touched on it, specifically, you know, the circular financing that's going on among the hyperscalers. If you look at NVIDIA, OpenAI, the likes of Oracle, just your views on that. I mean, is it getting to a territory where these kind of things are really becoming very unhealthy?
I think some of the circular financing is unhealthy, yes. But I think what's incredibly important is we own Meta, and Alphabet, and Microsoft. And the reason we own those three is because their core businesses are fantastic and are growing, and will continue to do that, sort of whatever they end up doing in AI. I think one has to be a lot more careful, choosing my words carefully, in the pure AI plays, because it's still not clear who the big winners are going to be, but also whether those that are far ahead today can maintain that lead in 5 or 10 years, which is the sort of period that we're looking for. So the answer to your question is, I think some of the circular financing is distinctly interesting, to use a polite term, but I think we're not particularly concerned, given the three that we own, because their balance sheets are so strong and they're throwing off so much cash. They're not really involved in that. It's the pure AI play, you know, OpenAI, and the pure AI plays where they are making an investment in order to buy chips, or the chips are being sold back to them or something. It's that is certainly a little bit problematic if it's a pure play that you're invested in. But the three that we have, their underlying businesses are good, their cash flows are good. So it's not something which concerns us about those three.
But especially if we look at something like Microsoft, and indeed benefiting from, you know, a bit of a weaker dollar, because we look at their revenue source. So it's all about looking, you know, at the fundamentals, not the hype. And like you mentioned, return on equity, and eventually it will come through in price. I mean, the markets will wake up. Greville, thank you very much for the update. Really great to have you. Always a pleasure to have you on board. An absolute delight. And thank you so much for your time and waiting patiently. Thank you.
Thanks, Eugene. Nice to see you. Cheerio, everybody. Bye.
Yeah. Right, our audience, thank you so much for joining us this morning. Next week, Wednesday, we have day 3 of our Offshore Managers webinar, and we'll continue some of these discussions. There might be some new questions popping up then before then that we could try to address as well. Thank you all for your time this morning. Like I mentioned in the beginning, we will be sharing all the presentations and recordings if you want to go through some of the notes and some of the slides again. To Avi and the team, Dan from Excel Academy, thanks for running the session. To the BCI teams, thank you so much for your efforts in putting all this together. And we wish you all a fantastic week further, and looking forward to seeing you again next week, Wednesday. Keep well.